Do you ever wonder what happens when the world's most powerful companies start buying from each other in circles? When one invests in another, that one spends billions buying back from the first, and both report record profits? It sounds like a magician's trick, but it's not. It's happening right now, in the center of the artificial intelligence boom. Welcome to FluxFolio Finance. Today, we'll untangle the billion-dollar feedback loops linking OpenAI, Nvidia, Oracle, AMD, Microsoft, and others, and ask the question no one in Silicon Valley wants to answer out loud. Is this still innovation or the early sound of a bubble inflating? The Great Money Loop. Let's start with the chain of transactions that has the finance world buzzing. In May 2025, Reuters reported that Oracle planned to buy about $40 billion worth of Nvidia chips to build data center capacity for OpenAI's US project, codenamed Stargate. A few months later, it was revealed that OpenAI and Oracle had signed a multi-year infrastructure agreement valued at roughly $30 billion per year, adding up to about $300 billion over several years. The idea: Oracle builds and runs massive cloud capacity, OpenAI leases it to power its models. Then, Nvidia itself announced it would invest up to $100 billion in OpenAI, while continuing to sell the same company its most advanced chips. According to Nvidia's official press release, the partnership includes deploying up to 10 gigawatts of Nvidia systems for OpenAI. In parallel, AMD signed a supply deal with OpenAI and, as Reuters confirmed, granted OpenAI the option to acquire up to 10% of AMD through future warrants. That means OpenAI could end up owning a piece of one of its own suppliers. Now connect the dots. Nvidia invests in OpenAI. OpenAI buys Nvidia chips. Oracle buys Nvidia chips to build data centers for OpenAI. OpenAI pays Oracle to run those centers. And AMD joins in, giving OpenAI a stake while selling it hardware. Every arrow in this loop points both ways: investment and spending feeding each other. All perfectly legal, all publicly reported, and all creating the appearance of unstoppable growth. The scale of the boom. This isn't pocket change. According to Gartner, global AI spending will reach $1.5 trillion in 2025, hardware, software, and services combined. McKinsey calls it a $7 trillion race to scale data centers and compute capacity. The United States alone attracted over $100 billion in private AI investment in 2024, according to Stanford's AI Index 2025, more than 10 times the next country on the list. And Reuters notes that nearly half of S&P 500 companies now have medium to high AI exposure, representing around $20 trillion in market capitalization. That's almost half the entire index tethered, directly or indirectly, to the AI narrative. Everywhere you look, money is being rewired around artificial intelligence. Data centers are sprouting across America, Europe, and Asia. Energy utilities are renegotiating supply contracts to meet the compute demand. Construction, semiconductors, power grids, all are being repriced for an AI world. But here's the question: if so much money is pouring in, who's paying out? The illusion of infinite demand. Right now, most of AI's spending is infrastructure: chips, servers, fiber, and cooling systems. Actual consumer spending on AI services, subscriptions, copilots, creative tools is a fraction of that. Analysts estimate it at roughly 10 to 15 billion per year, depending on definitions. That's real revenue, but tiny compared to trillion-dollar valuations. In other words, the builders are outpacing the users. The ecosystem is investing as if AI will be everywhere tomorrow, while the market for finished products is still finding its shape today. This is what economists call front-loading the future, paying for tomorrow's productivity before it arrives. And that's not necessarily bad. Every revolution begins with over-investment. The railroads, the telegraph, the internet, they all built too much, too fast. But when everyone funds each other's growth at once, the line between innovation and speculation blurs. What AI can really do? Let's separate reality from hype. AI can absolutely write, code, design, summarize, and analyze. In logistics, it predicts demand better than humans. In healthcare, it accelerates drug discovery and imaging diagnostics. In finance, it automates compliance and forecasting. Companies that deploy AI strategically, not just for show, report measurable gains. McKinsey's 2025 survey found that 78% of businesses use AI in at least one process, and some report productivity gains of 20% or more in targeted workflows. But there's a catch. Those benefits rarely hit the bottom line immediately. Running large models costs real money: power, servers, GPUs, bandwidth. Many firms quietly admit that inference costs have outpaced the savings. 80% of companies, according to Maverick AI's 2025 report, miss their AI cost forecasts by double digits. So yes, AI works, but the economics are still shaky. The dream is solid, the cash flows are not. Why some say AI is a bubble. A bubble isn't just when prices rise. It's when prices rise faster than the underlying reality. And right now, AI valuations are racing far ahead of adoption. The Magnificent Seven tech firms, Microsoft, Apple, Nvidia, Alphabet, Amazon, Meta, and Tesla, together represent almost 40% of the S&P 500's total value. Their collective growth depends heavily on AI optimism. That concentration is both impressive and dangerous. If AI spending slows, even slightly, half of Wall Street's momentum could reverse. Then there's the circular financing itself. When suppliers fund customers and customers fund suppliers, the same dollar can be counted twice. Once as investment, again as revenue. No fraud, but fragile. Even Moody's has warned that Oracle's $300 billion in newly signed AI contracts bring counterparty risk, since a few partners now account for most of its projected growth. If any link weakens, the whole chain wobbles. Why others say it's real, but the optimists aren't blind. They argue that AI isn't just a product, it's infrastructure. Like electricity in the 20th century or the internet in the 1990s, its full impact can't be measured by immediate profit. The investments of today might power an entire generation of digital productivity tomorrow. Think of those billion-dollar data centers as digital railroads. At first, overbuilt. Later, indispensable. If AI truly delivers compounding productivity across science, software, and services, then this may be the most necessary overinvestment in decades. Even Sam Altman, OpenAI's CEO, admits investors are overexcited, but insists that the long-term value justifies it. Someone will lose a phenomenal amount of money, he said, but the technology itself is real. The real risk, synchronization. Still, the most dangerous risk isn't fraud or failure. It's synchronization, when everyone's fate is tied to the same story. Today, the same few players dominate every layer of the AI stack. Nvidia makes the chips, and TSMC fabricates them. Microsoft, Amazon, Google, and Oracle provide the cloud. OpenAI, Anthropic, and Cohere build the models. Meta, Adobe, and others integrate them into apps. When confidence is high, that alignment drives exponential growth. When sentiment turns, it can unravel fast because there's no diversification. If a single supply chain shock, power shortage, or regulatory pause hits the system, those circular flows of cash could slow at once. And a synchronized slowdown is exactly how modern bubbles pop. The human side of the cycle. The irony is poetic. We built machines to think for us, yet we're still ruled by the same emotions that drive every market: greed, fear, envy, pride. AI might optimize production, but it can't optimize human psychology. Investors still chase momentum. Executives still fear missing out. And valuations still float on collective imagination. Maybe that's fine. Every technological leap requires a bit of mania. The internet crash destroyed paper wealth, but left behind the infrastructure for the digital economy we live in today. If the AI cycle follows that pattern, the correction will hurt, but the future it builds may be worth it. So what should we watch? 3 simple metrics tell the story. 1. Utilization. How much of this new AI infrastructure is actually being used productively, not idling? 2. Return on compute. Are we getting more useful output per dollar of GPU? 3. Real productivity data. Does GDP per worker or per hour worked start rising meaningfully in AI-heavy economies? If those metrics move up, the bubble narrative fades into a foundation story. If they don't, the next correction could be the biggest tech repricing since 2001. So, is this an AI bubble? Probably not a fake one, but maybe a front-loaded one, a race that's sprinting before it learns to breathe. Because right now, too much money is chasing too little proven demand. And while the technology is revolutionary, the market behavior around it is classic. Speculate first, justify later. The difference between brilliance and a bubble is simple: whether the profits arrive before the patience runs out. From skepticism to certainty, our dialogue has led me to one conclusion. AI is absolutely real. Its potential is vast. But so were the railroads, the telegraph, and the dot-com dream, and they all had their reckoning. In the end, progress survives. Excess does not. So watch the loops. Follow the cash. And remember, when money moves in circles, it can feel like growth until it stops. Thank you for watching FluxFolio Finance. If you found this breakdown useful, don't forget to like, subscribe, and comment your thoughts below. Do you believe AI is the next industrial revolution, or just the next great bubble? Until next time, stay curious, stay rational, and stay ahead.